Right. Good afternoon, everyone. This is Rich Swerbinsky with the Mortgage Collaborative here with the last week in Mortgage Today, our weekly walk through all the latest news, happenings, events in the mortgage industry. Each week, I am thrilled to be joined by one of our lender members as my co-host. And this week, very excited to have the CFO of Homestar Financial Corp, Stacy Mohr, with me. Stacy, great to see you.
Thanks, Rich. I'm so excited to join you today and have a good conversation about top news.
Love it. Love it. Love it. Homestar, one of our newer members of TMC. And Stacy, if you could, just to kind of level set with the audience, tell everybody a little bit about Homestar.
Sure. Yeah. So Homestar is based in Gainesville, Georgia, and the company was started 19 years ago. We're excited to be celebrating our 20-year anniversary next year. We've been growing across the country. We're currently licensed in 28 states, on our way to nationwide. Have been, seeing some great growth through the whole company, doing about 300 million a month currently, and watching that continue to grow as we expand our footprint. Got our start and our kind of claim to fame in the government space, especially USDA is a big piece for us. But obviously, as the markets change, we've grown to offering all of the products that are available to mortgage bankers like us. So we're looking forward to continuous growth and just watching the company flourish.
Very cool. Great to hear. Congrats on all the success. And start by getting into the latest news headlines. And let's start with some news that has started breaking a couple days ago. Nothing official on this, really, outside of speculation, but anybody that has watched the news on any level knows about the infrastructure package that is wallowing its way through Congress. Originally slated to be about $3.5 trillion, just facing some opposition from both sides of the aisle on different levels in an effort to reduce it a little bit. And then some news breaking this week where it seems like, part of what's getting chopped off on the cutting room floor is much of, if not all of, the affordable housing related tenants in it. Most notably inside that, some dollars that were set to be allocated for construction of affordable homes. Just something we've been talking about on this show for many months now is just the shortage of homes in America, depending on who you read and what you look at. Roughly 7 million less homes in America than we need right now. And at the lower levels, that first-time home buyer, more affordable home level, problems even a little bit worse. So at least for me personally, this was one of the things in the infrastructure bill that I was pretty intrigued and excited by, but looks like it could be lost in the lurch now. Your thoughts on this latest news and just in general, some of the housing tenants that were slated to be included in that infrastructure bill?
Yeah, it really was a big chunk, right? It was a big deal for our industry, how much money they were looking at putting towards these issues that we're facing. I think all of us may have been a little pleasantly surprised when we saw how much was being dedicated to this. So in some respects, because that was a surprise to us, maybe it's not quite so surprising that it might not make it to the final cut. But the way that I see it, there's two pieces in there that I wish we could separate, because one of them is the housing tax credits, which is going to increase demand and not supply, right? That's not something the industry needs right now. That's not to say we don't need it, but we don't need it right now when demand outstrips supply by far. The pieces that we do need are the pieces that are going to increase the supply, especially at the lower price points. There's just so many buyers than there are homes available, and we need something to help us get that supply and demand more in balance. So I'm kind of holding out hope that maybe some of the smaller pieces can be put back in there, and we can get a little bit of help instead of completely taking out this huge chunk all in one. So I guess we'll have to keep an eye on it over the next couple of weeks and see if any of them are officially taken out, which ones are officially taken out. Obviously, we'll look for opportunities to contact our representatives any chance that we get to voice our opinions on the pieces that matter to our industry. But yeah, it's hope is not lost yet.
And that's a great point, about the different components to the 300 billion. As you noted, like a lot of us in the industry, I think were surprised pleasantly at how much was included in the infrastructure package for housing, 300 billion. Inside of that, 100 billion in tax credits. And again, I'm not saying it's a bad thing, but to your point, we have no shortage of demand for housing. What we need is supply. And there was also a big chunk in there that was kind of earmarked for the construction of lower priced homes. So, and that seems to be where the debate is kind of centering now this week. Is, I know Maxine Waters and some of the other politicians that are involved, they're fighting certainly not to have any cuts made to the housing component of the bill. But short of that, asking for smart snips with the scissors and not the hedge clippers. So it'll be very interesting to see how this plays out, both with the housing tentacles and the bill in general. It's been, I don't think, not quite as easy as road as anybody thought with the infrastructure package.
Yep. We'll be watching that for sure.
Excellent. Moving on to the interest rate climate, we've had bump up in rates. This is the highest rates have been in a little while, not like they're astronomical, and low threes on a 30-year fixed today, 3.1, 3.2, somewhere in that ballpark.
Yeah. Isn't it funny that we're seeing a kind of a knee-jerk reaction if it bounces between starting with a 2 or starting with a 3, and neither of those were feasible a couple of years ago. To think that you're thinking that a 3% interest rate is high is just really funny. But it's true, as it's crossing over that threshold, we're seeing the headlines really change in terms of, oh no, what does this mean? Rates have gone up, or hey, we're back in the 2s, rates have gone back down. For us, we have always been very heavy on purchase. We're not seeing volatility in our pipeline as much as some other lenders may that have a bigger percentage of refinance, but it's bouncing around that 3 mark. And I do think that the headlines help, the advertisement that we get from news agencies help when the interest rates are starting with the 2s. So any chance we get of that is going to give you a little boost.
Yeah, just in general, I figured I was talking to you about this the other day, but just not surprising because mortgage companies have had a good couple of years. A lot of mortgage companies, just in general, like the big ones, advertising, if it's commercials for sporting events or sponsors for, large popular podcasts, but it helps everybody, because somebody may hear an ad for another mortgage lender and then think, oh, hey, I got to call my friend at Homestar to see where rates are and see if refinancing makes sense. And that's something we haven't seen typically. Major national advertisements for mortgage companies. But yeah, to your point, it has been in the news a lot. And, I think a big part of that is, though, that housing affordability in general is so tenuous right now that if, you were to get what people have been predicting for like a decade, that's never happened, 30-year fixed rates to go up to 4% or over. You combine that with, home values increasing and supply short of where demand is, and really could make the affordability piece of housing in America some pretty tough sledding.
Yeah, I totally agree with you on that.
Yeah. And along those lines, there was a report that came out, I think it was realtor.com that put out their monthly housing affordability report, came out yesterday, and it improved a little bit from August to July. Overall housing affordability as measured by an index that they put together. But if you look at a more holistic trend, looking at August of 2021 versus August from a year ago, median family income up 3.9% from a year ago. But the average monthly mortgage payment up 13.9%. from a year ago, and the average existing home sale price up almost 16% for a year ago. So really puts things in perspective on housing affordability in general in America right now.
Yeah, the nice headline, I guess, is that little bump that you mentioned from July to August, that we're finally seeing a trend in the direction for improving. But this past year has been really hard on housing affordability, just compounding the issues, not only in terms of housing, but the inflation that we've dealt with for the past year has dug into people's paychecks as well. And so with income only going up 3.9%, generally inflation at elevated levels, and then piling on top of that the housing affordability, you're really squeezing the paychecks in order to get someone into a home. And that's unsustainable, right? I mean, at some point, something's got to give. We can't keep going up on that. So I like that there's a glimmer of hope in the August data, that we saw, a slight improvement for 1 month. And hopefully we can improve that trend. I don't think anything drastic is going to come, but we'll take small moves in the right direction.
This is the last week in Mortgage Today. I'm Rich Swerbinsky with the Mortgage Collaborative, joined this week by the Chief Financial Officer from Homestar Financial Corp, Stacy Mohr. And as always, we welcome your questions, comments, participation in the show. Any questions anyone has for Stacy or I, just put it in the chat or the Q&A, and we'll be happy to voice it aloud. And did have a note come into the chat. How can we create more housing when at the local levels, counties and towns are increasing building fees that are nothing but income fees for municipalities? Until those fees are curtailed, builders and affordable housing will not occur. In California and Utah, building fees have increased 31%. And that is really a great point. And it is, I mean, we got, some builder-owned mortgage companies are part of TMC, and, we talk to the builders fairly frequently, and it's really, it's tough to make money if you're a home builder building a home less than $450,000. And, on top of that, they really are getting hit with a lot of fees and taxes and a lot of impediments, kind of hands in the cookie jar at different various levels of government that make building homes in general, when not even thinking about the supply side issue of what lumber and supplies have cost, really difficult. And I don't know, like in the infrastructure bill, the component of it that was kind of earmarked for building affordable housing, I don't know the breakdown. I think it was like 45 billion that was tagged to that, how that was broken down, how that would help builders. But it's a great point by the viewer that chimed that in. It's we have to solve that problem here first in America, right? I mean, we gotta build more houses, and if we don't figure something out soon in a way to make it easier for builders to do that, while heaven forbid still making a profit. I know nobody wants anybody in housing to profit, but in reality, it's what drives action. So, your thoughts on just the home construction part of our industry right now?
Yeah, it's a really complicated issue. There's lots of layers, and that's where I do think we need to be advocates for our industry, paying attention to what's going on in your state, in your local jurisdictions. And if there's something that's going to impact the ability to build houses, get your voice heard out there, that this is an issue that we need less restrictions on instead of more. I happen to live in California, and I do know that California has made some positive changes in that just recently. Being able to add a second unit to your home without having to go through the environmental review, and a couple of other pieces that are making it a little bit easier to add housing units. We need more of that. Whenever something like that is up for discussion with your representatives, you need to reach out, get your voice heard, let them know that this is an important piece for our entire economy, because there are lots of pieces to it that have to be either stopped from being added or to be reversed if they're already in place, if we want to really solve this housing issue. Because we have built a system that makes it very difficult to add affordable housing because of the costs of building.
Such a great point. And also the great point about reaching out to your local representatives. I mean, it takes 5 seconds to Google, even if you don't know who your local representative is in the House or your senators. Google it, you'll find their email addresses within 5 seconds of typing in Ohio senator or California. And they make it easy to get to, it's probably not them, but staffers that are feeding them things. And this is a huge issue. And I just, it amazes me that it's not getting more attention at the government level, because housing is an expense for nearly all Americans if you own a home, or if you rent a home. And now we've seen over the course of the last few weeks, report after report about rents spiking, up like 11% rents year over year. The recent trends in recent months are even higher spikes, and year over year rents are up in the mid 20s in percentile wise in some of the major metropolitan areas of America. The show I do with Rob on Friday, he talks all the time about, he's got a couple friends that own a lot of investment properties, and he's like, they're the last thing they want to do is sell those right now. Their value's going up, they're raising their rents. Like, I mean, it is amazing to me that with home prices up now 19% year over year, and how that is impacting the pocketbooks of Americans and the prospective home buyers that the Biden administration wants to help, that they're not getting to that core root problem, like kind of putting the cart before the horse.
Yeah, very true. On that rent issue, I think the number of investment properties that go through our industry kind of didn't get a whole lot of attention before, for the average company, but the PSPA amendment issue really brought that to light when we all started looking at how many investment properties we're putting through our pipelines. And so all of those investment property houses not only dealt with the higher pricing thanks to that PSPA amendment, but also are dealing with the same mortgage payment increases that we were just talking about a few minutes earlier. And all that feeds down into the rental prices. So it's a very active market. Investors are buying at the current higher prices. They were paying higher rates for to offset the PSPA adjustments that many lenders had to put in. So that's going to increase the rent prices. Now, luckily, we have a temporary reprieve from the PSPA amendments, so that relieves a little bit of that pressure there, but it doesn't change the perspective that prices are going up. The cost of owning a home is going up, and that's going to feed back into rent prices.
That's a great point about the percentage of investment property loans that lenders are doing. And like, I found it somewhat surprising to me when, they put the PSPA caps in place, pre-Biden administration. And I remember thinking to myself at the time, like, oh yeah, it's going to impact some lenders, but maybe not all at the 6 or 7% level. But then, as we got a couple weeks into it, like almost all of our members are like, oh my God, this is a major, major problem. And maybe it's just nobody buys investment properties in Ohio. That's probably more true in Ohio than other states. But when I was a lender, I don't remember doing 6, 7, 8, 10% of our business in investment properties. But I think you hit the nail on the head. There's more investment property lending as an overall percentage of the pie right now. And that's probably what led to the PSPA amendment about the caps. Mm-hmm. So, yeah. Sticking on the regulatory front for a moment, have a new director of the CFPB that has been now confirmed, Rohit Chopra. Your thoughts on the new director and just the general regulatory climate for a very nice sized independent mortgage banker like Homestar, as we move into the latter part of 21 and into 22 here.
Yeah, you know what I'm going to do? I'm going to piggyback on your co-host from last week, Rich. Is it Wydell?
Yeah.
Okay, I want to make sure I say it right. Rich, thank you for sharing this with me. I wrote down what you said last week, which was all drama comes from sloppy agreements. This is a message that I want Mr. Chopra to hear from our industry, is that we all want to play within the box. Just tell us what the box is. The gray areas is what makes it so difficult for the good guys to compete, to feel good about what they're doing when we're having to make decisions that, other guys are making different decisions than us, and we don't know who's right, and we don't know when the enforcement action is going to determine who was right. So, I feel like I'm on an advocacy kick today, but if you get a chance to share this message, if you have any opportunities to speak with a representative that has a meeting with Mr. Chopra or any other industry opportunities, we want to share that message. It says, just be clear, just let us know what the rules are. And I know that, the TMC members are good companies that want to play in the rules. We'd just like to know what they are.
Yeah, it's a great point. And it's one of the most talked about things. If it's at a TMC conference or, our networking calls that we do, is interpretations of like regulatory guidelines, and if it's LO compensation related things, like, can I ding for this? Can I ding for that? Can I pay this person that way? Can I change comp plans for an LO every 3 or 6 months? Or if it's RESPA related, gray areas, is this legal? Is it not legal? Or now I think, with the focus on fair lending, there's going to be, a lot of speculation there amongst lenders as to, like, just tell me what I need to do to be in compliance, as opposed to, what we saw during 2 CFPBs ago with the Cordray, when Rich Cordray was leading it. There was intentionally no direction. I mean, I distinctly remember, hearing him speak on multiple occasions where you could tell he was going out of his way to be murky, to, I think, scare is the wrong word, but, put some fear in lenders. But to your point, what that created was gray, where we hear it all the time from our members that are competing against companies that maybe don't have the best morals, that are doing these magical, technically illegal comp plans, or are just in plain violation of RESPA. So if you're not clear and there are not clear lines, not only does it confuse and bewilder good companies like Homestar, good leaders like you, but I think it opens up the box for the bad actors to wiggle around a little bit.
Yeah. There's plenty of space for everyone to compete and play within the box, but just the more definition around that, the easier it is for everybody.
This is the last week in Mortgage Today. I'm Rich Swerbinski with the Mortgage Collaborative. This week, joined by Homestar Financial Corp's Chief Financial Officer, Stacy Mohr. Got 5 or 6 minutes left with Stacy this week. And Stacy, the general business climate as we get into the tail end of the year here, it's been a good year for the industry. I mean, I think what we've consistently heard is lenders like Homestar that are focused on purchase business be damn near just as good a year from an overall production standpoint, if not better, than last year. Who would have thought that at the beginning of the year?
Yeah, it's funny that, so many years we say, who would have thought that at the beginning of the years? It seems like every year it never comes out like we planned, but certainly I don't think anyone at the end of 2020 thought that 2021 would be as good as it is. The beginning of the year started us off right. We didn't have that winter lull, carried us right through into the, spring season, summer. Our fall, we're feeling a little bit more like a normal year where, things calm down a little bit in the fall, but certainly not a drop off, nothing drastic. So we're going to be able to finish out a really spectacular year for Homestar. And I think that a lot of lenders will be able to say that 2021 has been another great year.
How many other industries are there where you can say that, though? Like, because you're right. Like, you get to the end of every year, and I do nothing but follow what's going on in the mortgage industry. It's my entire life. I mean, to a fault. And every year, what happens at the end of the year is nowhere near what I thought was going to play out at the beginning of the year. It's just, it makes it, I guess, interesting, keeps us all on the edge of our seat, but it's just something that those of us in this industry have to contend with. It's like a roller coaster. We are very much dependent on government policy, an interest rate climate that could go left, right, up or down at any given moment. And it's like, be ready for anything in this industry, right?
Yeah, that's what really attracted me to this industry when I got my first taste of it. Is it's so dynamic, it's ever changing, it's exciting, and you just never know what's going to happen next.
Margins got to be starting to compress even more. I mean, let me, I guess, lay out my interpretation of how margins have kind of played out over the last year or more here. And let me know if it is in line with what you've been seeing. Well, last year it was just like, well, first of all, last spring, everybody thought their companies were ending and the world was imploding. And then you get into the summer, people are like, oh my God, this work from home thing's great. We're busy. You get into the fall, people are like, of last year, I can't even believe how much money we're making. Like margins are unbelievable. We get into the winter, it stayed busy into the beginning part of this year, busier than everybody thought. January and February were good. At months, margins stayed strong. You get into the spring and the summer, margins were still hanging in there, at least from what I heard, like better than people thought they would have been last fall. But now you've got to, with refis really starting to bleed away, the supply side limiting to some degree, purchase market, the interest rate climate and margins got to be getting a little tighter and a little bit more competitive right now, no?
Yeah, I think we're just starting to see it. The rate change just happened in the last couple of weeks, so it hasn't been anything that's been a consistent pattern for the past couple of months, since the summer peak. But we're starting to feel a little bit more now, and I think that will be felt more between now and the end of the year.
Work from home, where are you guys at with that? You bringing people back to the office, keeping everybody home? I'm always interested to hear. Some companies are like, everybody wants to come back. Some companies are like, nobody wants to come back. Some are like letting people do what they want. Where's Homestar at with that?
Yeah, Homestar has really adopted the work from home climate. We are definitely tapping the talent pool from across the country. That's why I'm sitting here in California while the corporate office is in Georgia. Definitely taking advantage of all of the opportunities that provides. We do look forward to in-person things. We've got an annual event that we're going to bring people to in person, but provide a virtual option for those that aren't comfortable for that yet, being very aware that everyone's got their own reasons for making those decisions. But in terms of bringing most of the personnel back into one central location, we don't see that happening anytime soon.
Yeah, and most are the same way. And it is a new dynamic for our industry, though. I always worked as a lender for banks in Ohio and went into the office every day. And, we were an Ohio lender. I had to hire Ohio people. I took this job and it's like, okay, always were remote. Like I can hire people from anywhere. This is way easier.
Right.
And now, CFO, company doing 3.5-4 billion a year in mortgage production, and you're running the whole financial infrastructure of the country from California. You can hire people really from anywhere across America. It's a different dynamic.
Yeah, it is. Yeah, and it's got a lot of positives to it.
What else, Homestar have in the hopper as we head into the back end of 21, 22? Anything new, exciting, anything that's got your eye? I know you said you're going to MBA annual next week. Any theme to your meetings? Any, specific things you want to accomplish out of being with a lot of people in the industry next week?
So my initiative, my whole focus is really on data. I want to eat up as much data as I can and see what I can get out of it. I think the market is ripe in terms of technologies for all of the analytics to make better business decisions. So I'm looking at the companies that can get me what I need in terms of those decision-making data points. That's going to be my focus for the next several months.
That's great. And it's funny you say that, like our conference, I know you were unable to attend a few weeks ago due to a previous commitment, but it was one of the things. I wasn't like shocked. I know that lenders are looking, data is obviously important, and not just like the data on your LOS, but other actionable data. But I was really, again, not surprised, but encouraged at how top of mind that was for our members. If it's, recruiting people or understanding market demographics across America and markets that you're not in and where there's opportunity for you. The ways that lenders and leaders like yourself are able to use data to drive decision-making, it's a whole different ball of wax from just a couple of years ago.
Yeah, the time has never been better to take on initiatives like this. Just the technology has ramped up so much over the past couple of years, and I really want to be able to take advantage of that.
And one more question come in before we depart. Rich, if you could ask Stacy what her take is on remote originations and how they are keeping the mortgage IQ on the increase. Real estate has failed in that respect, where we see the realtor IQ diminishing. So point being, online realty is lowered. The realtor IQ is risk of that with the mortgage originator.
Yeah, you know what? My gut is that that's more of a fad, that we're going to kind of reverse course on that and go back to building up the IQs on those types of things. I think it's kind of trendy to do and try to put as much technology in any piece that you can, and let the computers do the work. But there's some things that are better left to, real expertise that needs to stay there.
Well said. Stacy, thank you so much for joining me this week. Always enjoy chatting with you, talking about the industry, and appreciate you and your membership. And looking forward to seeing you next week in sunny San Diego.
Thank you, Rich.
To our attendees, thank you as always for taking 30 minutes of your week out with us. We're here every week on Tuesdays at 2 p.m. Eastern live with the Last Week in Mortgage Today. And then, of course, we upload this to our YouTube page and release it as a podcast where I know a lot of you listen or watch as well. So until next week, have a great rest of the week, everyone. Take care. Bye, Stacy.
Bye.